Hello and welcome again. Welcome to a long overdue video on financing. In this video, I will talk a little bit about different sources of financing. Basically, now that we know the projects that we want to invest in, where basically do we get the money to fund those projects? I will talk about a couple of different issues relating to that. And then at the end of this video, we will be talking about the relative advantage formula for debt versus equity, which will help you answer one of the questions in your individual assignment. All right. So effectively, there are three sources of funds, three sources of financing. This could be internal funds. So basically, your company has some profits, has some earnings, and in the simplest case, it has two choices. It can either distribute those funds in a form of a dividend to shareholders, or it can simply reinvest those funds back into the projects that the firm deems are appropriate positive NPV projects. There are a couple of interesting considerations here. First, there is evidence that firms rely on their internal funds too much, therefore foregoing some potentially risky projects, but the ones with positive NPV. They kind of don't want to issue debt that could cause financial distress, because then you end up owing money to your bondholders. They don't want to issue equity because that dilutes their ownership, because equity shares it effectively. Well, there's claims to ownership. The second one is debt. Bonds. Company borrows, the company issues bonds. And the third one will be equity. So basically, these are the three sources of funds. And what I want to talk about next are cash flows that are associated with these sources of funds. So basically, when you are a bondholder, you are safe. You are the first in line to obtain cash flows, but your potential return is limited. When you're an equity holder, you are basically the last in line to receive a payout, but your return is potentially high. Again, something that we have talked about in class hours and hours and hours on end, risk-return trade-off. So first in line, let's say this is my cash flow. First in line, we have bondholders. Then next in line, we have preferred stockholders. Preferred stock is a hybrid security. It has features of a bond, it has features of a stock. It is an equity stake, but its dividends are actually fixed. I'm not going to go too much into that detail. It's not terribly important for the purposes of this video. And then we have common stockholders. Okay, so let's say that in year 2018, my company has only received this much cash. Okay, so all the bondholders get paid. Preferred stockholders get only part of the payment. Common stockholders are the last in line. They get a big fat zero. Now, let's say that in year 2019, my cash flow was this much. Bondholders, again, get paid. They are the first in line. They always are. Preferred stockholders get paid. Common stockholders actually get zero. Why? Because the preferred stockholders were owed their dividends from a year ago. They didn't quite get the full share. The preferred dividends are actually cumulative. Okay. And let's say that in 2020, well, probably not the best choice of a year, but nevertheless, my cash flow is absolutely gigantic. My apologies for the low quality of the drawing, but let's imagine that in 2020 this firm strikes a gold mine and my payout is absolutely enormous. Bondholders get paid, of course they're always paid, but they only paid this much, not a cent more. I mean, why would I pay? I owe you $10 million plus interest. I will not pay a cent more. Preferred stockholders get paid this much, and again, not a cent more. The entire windfall of this huge cash flow goes to common stockholders. So I hope that this simple little illustration actually kind of shows the trade-off between being a bondholder and being a stockholder. Again, a bondholder, you're the first in line. The problem is that your payout is limited. As a common stockholder, you're the last in line, but if you get this incredibly high profit, these are the common stockholders, not bondholders or preferred stockholders, that will get the payout. Okay. Another issue that needs to be discussed. So let's say that my firm has its earnings. And let's say that I pay 50% as dividends. This is called the payout ratio. And I pay 50%, well, actually not pay, reinvestment. This is called the retention or a plowback ratio. I plow all this money back into the firm. So let's say that I want to keep my shareholders happy. What's the best way to keep my shareholders happy? Increase the share price. That's, well, pretty much the only way. So how am I going to do that? Well, at the most fundamental level, what is the stock price? What is the price of a piece of paper? The price of a piece of paper is whatever cash flow this piece of paper entitles you to receive. In case of a stock, these are the discounted values of all the future dividends. And I often get asked, well, what if company doesn't pay dividends? What if this one is zero? Wouldn't the value be zero? Well, no, we know it's not. I mean, what that means is that the reinvestment ratio, the retention ratio is 100%, which means that 100% is real. This is particularly relevant for very young firms. Okay? They can't really afford to have high dividends because they have a lot of projects to invest in. And eventually the key here is that eventually they will pay the dividend. So I think you see where I'm going with this. I want to keep my shareholders happy, so I increase my payout ratio from 50% to 80%. Will that increase my share price? The answer is no, it will not. Why? Well, because this one has to drop. What I have done here is I took money out of my left pocket and put it into my right pocket. Yes, I have increased my current dividends, but I did that at a cost. and that cost is a decrease in future growth and therefore future dividends. So over the lifetime, it will actually cancel each other out. Okay, let's go back to the original. 50-50. And let's say I do this. I increase my payout ratio to 70%. This one doesn't go too well. I think my markers are dying. But I don't decrease my reinvestment ratio. How is that possible? So it no longer adds up to 100%. Now it adds up to 120. Where do I get that extra 20%? I issue additional equity. Okay? Whether it goes in reinvestment, dividends doesn't matter, as long as this 20% now covers this 20% shortfall. So I issue extra stocks. Will that increase the price of the shares? And the answer is no. Think of it this way. The pie has grown. The pie has grown, absolutely. I have increased my dividends without sacrificing any reinvestment. So the size of this pizza has increased. The problem is I now have 20% more people claiming that pizza. So the size has grown, but now I have to divide it into more slices. Therefore, the two effects will exactly cancel each other out. I can do the opposite example when these two numbers actually add up to less than 100%, in which case the firm will actually buy back some of its shares. And again, this will not have a material change to the price of these shares. Again, I have a smaller pie, but I divide it into less pieces. The point is this: the only thing that can increase the value of my shares are projects with positive net present value. That is it. Nothing else, nothing more, nothing less. Okay. Before I move on to the next point, let me give you a simple example, actually, which comes from the bank's risk management. So those of you who have experience working in a bank would probably recognize it. Let's say that I have a very, very little bank, very small bank that only has two products. It has 2-year fixed deposits and 3-year fixed mortgages. Now, this is called, so my deposit is my liability and my mortgages are my assets. Remember, from the bank's point of view, everything is upside down. You tend to think of a deposit as your asset. Well, it is your asset, but it is bank's liability. So this is an example of what is called a positive duration gap. The duration of my assets outweighs the duration of, is greater than the duration of my liabilities. But the question is simple. I am this bank's risk management officer. What keeps me up at night? Am I afraid that interest rates will go up? Or am I afraid that interest rates will go down? Feel free to pause this video for a second. I'll give you the answer in just a little bit, but that is the question. What is bad for me here? Interest rates going up or interest rates going down? The answer is that I am fearful here that interest rates will go up. So imagine And again, I will use a very, very simple scenario. So let's say my deposits pay 2%. One is dead. 2%. And my mortgages are 3%. So after 2 years, I will, if interest rates have gone up, I have to increase my deposit rates. Otherwise, my customers will run away to other banks. So I have no choice but to increase it to 2.5%. The problem is I cannot do anything with my mortgage rates because it's fixed for another year. I hope that makes sense. The opposite will happen if I have something like this. If I have a negative duration gap. And again, 2% and 3%. Here, I am fearful that interest rates will drop. Because if they drop, I will have to drop my mortgage rates. Otherwise, again, my customers will run away to other banks. But I cannot touch my deposit rates for another year, okay, because they're fixed for a year longer than my mortgages. Well, in this case, you have probably guessed what's the solution. The solution is what is called zero duration gap, duration matching, interest rate immunization. In this case, I don't care whether interest rates go up or down. I simultaneously put all of them up or bring all of them down. What on earth does this have to do with financing? The general rule of thumb is if you have a 2-year investment project, financing it with a 10-year bond just does not make a lot of sense. Matching the duration of your investment project with the duration of your loan more or less immunizes you from the interest rate risk because you are matching the cash flows. Cash goes in, cash goes out. Okay, so I hope that makes sense. And finally, I would like to talk about what is called the tax shield. Okay. In principle, there is no no difference between issuing bonds and issuing stocks. I mean, you distribute cash either way. The trick is taxes. Interest payments are tax deductible. Therefore, there is this term, it's called interest tax shield. I will not go too much into detail, so this video is already 18 minutes. I will go straight to the chase. So let's say that your company earns $1. And you have a bondholder, or you have the stockholder. So what corporate tax will the company pay for a bondholder? The answer is none. Again, interest is tax deductible, all these payments. The payments to a stockholder will be taxed at a corporate tax rate. Okay. So at the end here, you still get $1. Here, you get, well, $1 times 1 minus TC. Then I am taxed at my personal tax rate. And here I am taxed at what is called the effective personal tax rate. Because it depends on the nature of the cash flow, whether it's capital gain, which is could be taxed, whether it's a dividend, which could be imputed. So this is the effective tax rate. So at the end of the day, the dollar that I get as a bondholder will be 1 times 1 minus TP. the dollar that I get as a stockholder, oops, sorry, 1 minus TC times 1 minus TPE. So the answer to the question whether you should be issuing stocks or bonds depends on which of these two is greater. This is what is called relative advantage of bond issuing versus stock issuing. I hope this makes sense. Thank you for listening. There will be a couple more videos coming in the next couple of days, so stay tuned.